So hey guys, in this short video I'm gonna explain you something that I learned yesterday, and it would have made me to not take the trade that I took yesterday, and and not have unwanted loss. So I am not worried about the loss because that is the part of the game and I have still many opportunities left. But I understood a new concept. Suppose market is moving like this. It has relative equal highs here. We have two scenarios in which you can see that the market is moving like this. Wait 1 minute. Mm. Yes, so we have two scenarios in which the market is moving like this, and we can see that at this area and at this area we have swing highs, and same as here we have swing highs. So these are buy side liquidities, and if the market does something like this, it goes up here and then it dumps, then it is a part of low resistance liquidity which is likely to be get swept after some time or after the next move. And if the market does something like this and then dumps, then the market sweeps the buy side here, and then this is uh, a very strong swing high. It will not get swept easily because this is the swing high that swept out this high and this high. So this is called as a high resistance liquidity. So this is called as a high resistance liquidity point, and this is called as a low resistance liquidity point, because we can see here is a trend line liquidity, and here is also trend line liquidity, but this high sweeps the highs, but this high swept the highs uh, that are in the left side of it. So this is a low resistance liquidity and this is a high resistance liquidity. Once again, if market is generating low resistance liquidity, then the market is likely to be doing something like this to sweep the low resistance liquidity. But if the market is generating high resistance liquidity, then the market will likely do this and then dump, because high resistance liquidity points are much safer as compared to low resistance liquidity points. So how to actually use it? You have to use it in such a way that it will benefit you. You have to use it in such a way that it has to benefit you. I tell you one more example. Suppose the market is moving like this. Okay, the market is moving like this. You can see we have low resistance liquidity up here, and we also have some relative equal lows at the bottom. So how to actually use it? If market did something like this, it sweeps it sweeps the sell sides first, which is the relative equal lows, and then market will do something like this. It will take out all the low resistance liquidity. So what to actually take out from here? You can see it is a form of low resistance liquidity, but we call it as relative equal lows. So when market takes this and generates this point, this is again the high resistance liquidity point, and it will get protected if markets wants to sweep the low resistance liquidity above. So you have to use high resistance liquidity points as your stop losses and low resistance liquidity points as your targets. And if market did something like this, now if your bias is bullish, so you don't want to take shorts. We can see that market has some liquidity here and some liquidity here. If your bias is bullish, so you will only take longs. But once market sweeps this low resistance liquidity or relative equal highs around this area, then this swing high becomes a high resistance high or a high resistance liquidity point. So it will get protected if markets wants to go lower. Okay, so in this scenario you have to take shorts with your stop loss around this area, so your stop loss is safe because the market will not sweep the high resistance liquidity without sweeping out the sell side. So basically I am trying to tell you that you have to use high resistance liquidity at the place of your stop losses and low resistance liquidity at the place of your targets. That's the reason why I had a loss yesterday and I have figured it out really well. Let me show you a real life example of it, and I lost around $148 from the same concept. Huh. So you can see that we have the 1 hour gap and 15-minute intermediate term low. We have relative equal lows here. So same example, if market sweeps this, then what is the objective for market? Buy side, not sell side. So buy side liquidity is extending throughout all the area, you can see. So if market sweeps this, then this is a safe spot for the market. So when market dumps down and takes this, then I was looking for longs, but here was no entry. So I waited for the market to give me a shorts toward this area, but I didn't knew that this is a high resistance liquidity point and it is safe now because market will not take this very easily. So what happens that we swept out the low resistance liquidity, and if we go on the higher time frame, we can see that we have much higher low resistance liquidity all above us. But I only but I was only looking at the lower time frame, so I only saw these, and I ended up taking a short from here. I ended up taking this short. A really nice textbook setup, but we have a 5-minute unmitigated gap, so I was using this as my break even point and I was thinking that the market will take this low because I did not knew the concept of high resistance liquidity, but I knew it now and I will implement it in my trading from now, and I will mark also like this high resistance liquidity. I will mark it as this now, so I have some idea that where to target and where to place our stop loss. So this is the same example that happened here. You can see this is the high. Okay, this is the high, you can see. Yes, and this is a small swing high. Market took this or not? Yeah, market also took this, and after the market took this, market gave a inversion. So this high swept out liquidity on the left side of it. So again this high is a high resistance liquidity point, and this is safe now. So I have told you that you have to use high resistance liquidity points as your stop losses and low resistance liquidity points as your take profit. So where is the low resistance liquidity? Low resistance liquidity is all the way here. This is low resistance liquidity all. So this is the high resistance liquidity and these are the low resistance liquidity. So you have to take a short here, place your stop loss above this and take profit at the low resistance liquidity endpoint. Very nice bangle trade, and you have to use a realistic break even point. So for me it is around this area because we have this swing low inside this value gap. So it is a nice break even point for me. Why did not I use this break even point? Because this is because this point is not inside of anything. So I hope you understood the concept of low resistance liquidity and high resistance liquidity, and I wish you that you will implement it in your trading. And yeah, until we meet again, be safe.